One of the first questions I ask traders when they ask for my help is, do you have a trading plan? Most say no, some say yes. To the ones who say yes, I ask, is it written down? Few say yes to that, and most say no, it's in my head, or something like that. And that's just not good enough. A goal without a plan is just a wish. That's pretty profound, but I didn't say it. That was said by the famous French poet and aviator, Antoine de Saint-Exupéry. Sorry for butchering his name to anyone who's French. My French is horrible. But the quote, like I said, is very profound and it's 100% true. A goal without a plan is just a wish. Is it your goal to be a successful Forex trader, or is it just a wish? If it's your goal, you need a trading plan. But why exactly? What does a trading plan actually do for you? Well, a trading plan gives you guidelines which keeps you from making common mistakes. A trading plan keeps you on track. You might think you don't need that, but you're not a robot. You're driven by emotions because you're human. When you get nervous, you are going to make mistakes. When you get confident, it's going to lead to overconfidence. And again, you're going to make mistakes. When you get bored, you might take a trade because you have nothing else to do and you just want to be in the market. And that is a mistake. A trading plan keeps you from making these mistakes. If you have guidelines in place that lay out the exact criteria for entering your trades, you're going to be less likely to make mistakes when you're nervous. You're going to be less likely to take risky trades because you're overconfident or because you're bored. But not only that, a plan's going to keep you motivated because you're going to lay out realistic goals in your plan and you will detail how to achieve them. And then as you meet those goals and see yourself improve, you will want to continue because the plan I'm going to show you will be realistic and achievable. A plan is essential for all traders, and I'm going to show you how to put together an amazing plan. Now, I know that writing a trading plan sounds daunting, but it really isn't. One of my main rules in life, not just in Forex in life, but especially in Forex, is to keep things simple. And I adopt that rule in my trading plan too. So this isn't going to be some 30-page essay-type plan. It is 3 to 4 pages, simple and to the point. So the question is, are you willing to dedicate 1 hour of your time in order to create a simple and powerful trading plan? This trading plan is split into 3 sections. These sections represent the 3 core skills of trading. These aren't in order of importance, they're just in a logical order for this plan. Skill 1 is trading psychology, Skill 2 is trading strategy, and Skill 3 is risk management. These are the 3 core skills that you need to master in order to become a successful trader. So each one of these skills has its own page in the trading plan. I'm going to explain the 3 core skills in more detail later in the video. So for now, just know that they're part of the plan. So let's start with skill number 1, trading psychology. Now, trading psychology is all about your goals, your strengths, and your weaknesses. Planning your goals before you start trading is going to give you an objective to work towards. Now, in this trading plan, we use something called SMART goals. SMART, in this case, is an acronym that stands for specific, measurable, achievable, relevant, and time-bound. Now let me break these down really quickly. A specific goal is much easier to achieve than a general goal. Now think about this in terms of weight loss. In weight loss, a general goal would be something like, I want to lose a lot of weight. But a specific goal would be, I want to lose 10 kilograms or 20 pounds, and over the next 3 months by working out 4 days per week. Notice a difference. One of these goals is very, very general. The other is very, very specific. So you're going to want to put together a specific goal for this plan. Next is measurable. Measurable goals answer questions like, how much and how will you know when it's accomplished? So a goal that isn't measurable might be, I want to make a bunch of money trading this year. But how much is a bunch of money exactly? That's not really something that you can measure. And how are you going to know when this goal is complete? Now, a measurable example of this goal would be something like, I want to make a 10% return on my overall capital in the next 6 months. Now, that doesn't sound like a lot, but for a new trader, that's a decent goal and it's achievable, which actually brings us to the next part of a SMART goal, achievable. Now, as a new trader, you're not going to be rolling in money. In fact, you might struggle to break even. So setting an achievable goal is important. Double my money in 3 months is not achievable, especially not for a new trader. However, make a 10% return of my overall investment. Now that's something that's achievable. That's something that you can do. Next is a relevant goal. A relevant goal simply means something that is relevant to you. You should not set your goals based on what other people want. You should set your goals based on what you want to achieve. A relevant goal should answer yes to these 3 questions. Number 1, is this goal important to me? That should be yes. Number 2, does this goal make the effort I need to put in worth it? That answer should be yes. And number 3, do I have the time and motivation to achieve this goal? That answer should obviously also be yes. So you want to make sure that your goal is relevant to you. If it's not relevant to you, you're probably not going to be bothered to actually try and achieve that goal. Now, finally, your goal needs to be time-bound. Having a goal without a time limit doesn't motivate you to actually work towards that goal. You might start dragging your feet, or you might just lose focus. So you need to give yourself a specific time limit. Now, here is a newbie-friendly smart goal for trading. Modify this as you see fit or come up with your own goal. 10% return in the next 6 months. There you go. Newbie-friendly smart goal. You can tweak the percentage if you want. You can tweak the time frame. You can even tweak the strategy if you want. However, like I said, this is a newbie-friendly goal, and this goal is specific, measurable, achievable, and time-bound. As for relevant, I cannot say whether this is relevant to you. That's up to you to decide. If it's not relevant, then do whatever tweaks you need in order to make it relevant. But make sure that you are using a smart goal. Now that answers the first question in your trading plan. What is your goal? Now, the next part of your plan details how you're going to achieve this goal. This is simple. You can put something like, I'm going to focus at least 1 hour per day on trading, or I'm going to focus at least 2 hours per day. If you can, why not? This is just your plan for achieving your goal. Next question. What are your biggest weaknesses? This is important as you need to be aware of your weaknesses in order to overcome them. If you're completely new to trading, you might not know your weaknesses yet. However, if you've traded before, you probably know what to put into here. For example, overtrading is a common weakness for new traders. They want to trade so desperately that they take too many trades, and inevitably they take a lot of bad trades. Some new traders have the opposite issue though. This is often referred to as paralysis by analysis. Transcribed so they spend so much time analyzing trades that when it comes time to pull the trigger, they freeze and they do not enter. So whatever your weaknesses are, if you know them, put them in. Next, how will you overcome your weaknesses? So here you want to detail a quick plan for dealing with your weaknesses. So if you overtrade, you might want to put something like this in. I will limit myself to 4 trades per week. Once I take those 4 trades, I'm going to close my trading platform and stop trading. You just need to put in a plan that's going to help you counteract those weaknesses. And finally, what is your daily trading routine? This is simply the steps you will take every day in order to trade. It's pretty straightforward. Here's an example based on my routine. Step 1. I check my economic calendar for any high-impact news. Step 2. I do my analysis on all pairs and timeframes that I trade. Step 3. I mark down any potential setups and check in on them during the day. So that is my trading routine. It's pretty simple. You should come up with something like that, or, if you really want to, you could just take mine. But as a new trader, you might also want to add a few extra things in there like practice, etc. So feel free to add more steps if you want. This is just my routine. Yours can be a lot longer if you want it to be, but try to keep it simple. Okay, so that completes the mindset portion of your trading plan. Make sure you fill it in properly, as this is going to keep you motivated, keep you on track, and it's going to give you a serious goal to work towards. The next part of your trading plan is your strategy. In order to fill this section in completely, you're actually going to need a strategy. This section itself is not that. It is just a breakdown of the key aspects of your strategy. This part is pretty straightforward to fill out, but it's also very important. Detailing your trading strategy and your plan is going to help to keep you focused on that strategy. Remember how I said strategy jumping is a very common mistake that new traders make. This is jumping from one strategy to another after just a few bad trades. Another issue that new traders often face is making changes to their strategy after just a few bad trades. So for example, they'll have 2 bad trades on GBP/USD and then they'll stop trading GBP/USD. This is a very bad habit to develop. Losing trades in Forex is normal. You might make 2 bad trades on GBP/USD, but then your next 4 trades might end up being good if you just keep trading. So sticking to your strategy and not changing your strategy, not altering it is vital. But how do you stick to your strategy? If it's not down on paper, it might be a little bit tough to keep to the same rules. Having your strategy on paper makes it a lot harder to just change it on the fly, and it makes it much easier to stick to your strategy. because every time you refer to your plan, you will see an outline of your trading strategy. So let's fill out the strategy section of your plan. Question 1. Which currency pairs will you trade? Here, you're just going to list the currency pairs depending on how new you are. You might have between 5 to 20 pairs. 5 is pretty much what you should have if you're a new trader. Next, what timeframes will I trade? Here, you just list the timeframes that you're going to trade. The sample plan is going to show the 4-hour, 6-hour, 8-hour, 12-hour, and daily. That's because those are the timeframes that I focus on. Next, what are my entry requirements? Well, this one depends a lot on your actual trading strategy. Like I said, my one's linked to below and you're free to check it out. But I suggest that you wait until after this course to check out the strategy. If you can't fill in your trading plan right now because you don't have a strategy, that's fine. Just keep watching and you'll get an idea of how to fill it out. Next, what are my exit requirements? Again, this is strategy dependent. And finally, when I decide not to enter trades, this simply lays out the main times you will not trade. You may want to list things like when high-impact news is going to be released during speeches by key political figures such as presidents or prime ministers, or even central bank leaders you may put in at Sunday open. So when the market opens on Sundays, trading can be a little risky, so you might not want to trade at those times. Many traders, including me, don't like trading on Friday afternoons after 12 p.m. in the US, as things can get pretty volatile around that time. So this is totally up to you. I've filled in a few examples in the sample plan. You can remove them or you can keep them if you want. Laying out the basics of your strategy is vital. If you wish to add more to this section, please do. However, my strategy is very simple, so I can summarize it in under one page. Now you might be wondering, what about stop losses and exits? Well, stop losses are related to risk management, which will be discussed next. Risk management is arguably the most important part of trading. I could give you the best trading strategy in the world, but without risk management, there is a strong chance that you would lose money trading it. Because finding trades is a lot easier than managing trades and getting the most out of trades. That is why I consider it one of the 3 core skills of trading. Risk management is a very extensive subject, and it takes a long time to master it. It took me years. It will take hours to cover risk management in full. But in this trading plan, I can give you a foundation for risk management that you can later build upon. So this is not all there is to risk management, but it's a very strong starting point for you. So let's take a look at the questions in this section of the plan. Question 1. What is your account type and size and any other relevant info? Here you're simply going to put basic account information. Something like, I have a mini account with 500. Or if you're in the UK, I have a spread reading account with £500. Whatever your account is, whatever size it is, whatever information you feel you want to put about your actual trading account, you can put it in here. Next, and this is an important one. What is your risk profile? This is a question that only you can answer. Some people are naturally risk averse. Others love to take risk. The reality is that changing your approach to risk is almost impossible. So it's a lot easier to recognize how you approach risk and work around it. Being risk averse like me can be a good thing and a bad thing. It's a good thing because I tend to only take really good trades, but it also means that I skip a lot of trades that I deem too risky. And sometimes those trades that I deem too risky end up being profitable. So I'm giving up on potential profit by eliminating trades that I deem too risky. Whereas a trader who isn't risk averse, a trader that likes to take riskier trades, will be taking those trades. They'll be taking a lot more trades than me. The downside for them is, generally, when they're taking riskier trades, they're going to lose more trades. But by the end of the year, this might even out, or the trader that's taking more risk might end up with more percentage gain, or I might end up with more percentage gain. And this is probably going to change year to year. The point is that there's nothing wrong with being risk averse, and there's nothing wrong with being a high-risk trader. You simply need to be honest with yourself and work around it. If you know you are a high-risk trader, you can set rules in place to limit the losses from high-risk trades. Like for example, you can risk less per trade or even better. You can vary your risk, which we're going to talk about in a second. So next question, what is your maximum risk per trade as a percentage? Whenever you enter a trade, you are risking a certain percentage of your capital. Having a maximum risk per trade allows you to control your risk over time. A lot of new traders do not think about risk. They start out risking 5% or 10% per trade, or even more than that. All of a sudden, they lose a few trades in a row, and they wipe out 40% or 50% of their account in a few days. And that's absolutely crazy. Trading is all about minimizing risk so you can grow your account and make money over the long term. Risking large amounts per trade is simply gambling. It is not trading. As soon as you hit a small losing streak, which is pretty normal, you're going to lose a major portion of your capital. And that's just not smart. So you need to set a maximum % risk per trade and stick to it. To keep numbers easy, let's say you risk 2% of your capital on every trade. This does not mean that you need to risk that 2% on every single trade. 2% is your maximum risk. If you are a trader that takes a lot of risky trades, which we figured out in the previous question, you might want to risk less on those risky trades. So you might risk 1% on risky trades and 2% on normal trades. This is called varying your risk. Just remember that if you set your maximum risk to 2%, then that is your maximum risk, not your minimum risk. You don't have to use 2% on every single trade. Next question. What is your maximum drawdown before you stop and reassess what you are doing? As a new trader, you should only ever trade with money you can afford to lose. This will ensure that you do not lose too much while you are learning. Even so, you need to set a maximum drawdown before you hit the brakes and reassess what you are doing. This means that you need to set a maximum percentage of your account that you are willing to lose before you stop and reassess. This could be 10% or it could be 50% or anything in between. It's up to you. I think a good number is 40% for a new trader. If you lose 40% of your capital, you're clearly doing something wrong. At that point, you need to stop trading and figure out what is wrong before resuming. Now, you don't want to keep this 40% for too long. Once you have a large trading account, you don't want your drawdown to be at 40% because that's a bit too much. But while you're learning, 40% is a good number. Okay, next question. Will you have more than one trade open at a time? Having more than one trade open at a time adds an extra level of stress to your trading, but it's not necessarily a bad thing. You just need to decide ahead of time if it's something that you want to do. If you don't want to have more than one trade open at a time, that's fine, especially while learning. Just write it in here and stick to it. If your answer is yes, that's fine too. But it also means that you need to answer the next question. And this is the final question. If yes to above, what is your maximum risk exposure at any one time? Having several trades open using your maximum risk might not always be a good idea. Now, let's say you have 5 trades open all at your maximum risk, which is 2%. That means that your total current risk is 10%. So that's 2% times the 5 trades you have open equals 10%. Now let's say a surprise news event happens like an economic release or a politician saying something that causes volatility. If all of a sudden all your trades spike against you, you can lose 10% in just a few seconds. And this is bad, so setting a maximum exposure is a good idea. If you set your maximum exposure to 5%, for example, you're keeping your account safe from surprise volatility. A good example of this was the run-up to the Brexit vote in the UK. Prior to the vote, and even after the vote, a lot of surprise news came out that caused unexpected moves. Now traders using a low maximum exposure were able to ride out these events with minimal losses. Whereas inexperienced traders who didn't really care about total exposure took scary losses. Setting maximum exposure may seem limiting, but it ensures that you stay in the game over the long run. Trust me, being down 30 or 40% and having to claw your way back up is not fun. So set a maximum exposure and stick to it. Okay? So that is your trading plan. So please, fill in your trading plan before you start trading. And remember, a goal without a plan is just a wish. Don't forget to like, subscribe, and hit the notification button. Check out Bullrush Academy for more educational videos and go to Bullrush.com or Bullrush.tech to start trading today.